on stock investing zero to hero. And it promises to be a very good session, and you'll see very quickly we're going to jump into some pretty advanced stuff. So delighted to have you all here. So before we get started, I wanted to take a second out there for anyone that's new on the call to explain what Bharosa Club's all about. So Bharosa Club was started by a bunch of us with financial service background that have been through the process of learning finance. And all of us felt that there was a much better way to learn finance, and that it was not taught in a very intuitive way that focused on understanding first and then building on top of that understanding with complexity. So that's what we're trying to do here in these sessions. And Bharosa Club's aim is to empower our members through better understanding to make better decisions from themselves in the financial services space. So with that, why don't we kick off the presentation? As Anita mentioned, we'll be taking questions. Just type them into the chat and we'll address them at the end. So whenever a question comes up, just feel free to put it on chat and we'll go through them at the end. And so with that, why don't we jump in? So let me just get the presentation started. So as mentioned, this is part 2 of our Stocks Zero to Hero. In case you missed part 1, you can find it on our YouTube channel. We'll also do a quick recap here so you're not lost. Great. So what did we cover last time? And, I urge people that haven't seen part 1 to go back and actually watch part 1. So this summary here is going to be at a very high level, and we went into more detail in the actual video. So I encourage you to see that. But in any case, a brief recap here. So the first thing we covered is we kind of understood at an intuitive level what buying a stock meant. So first of all, we understood that stock also means equity and shares. Those are just synonyms that mean the same thing. So one of the confusing things about finance is there are many words that mean the same thing. So this is one case of that. And buying a stock basically means buying a piece of a company. So what does that even mean? What does it mean to buy a piece of a company? It basically means that you have a right to a portion of the company's future earnings. So whatever profit the company generates, you get a piece of that based on how much stock you own. So you may have heard of debt investments also. So debt is basically like loans, bonds, credit, fixed deposits. These are all synonyms for debt. In a debt investment, you're actually lending money to a company. You're not getting a piece of the company back in return. They're agreeing to actually repay you your investment in the future. And you get an interest rate, which is your fee for giving them the money. So right there, we understand a little bit of why stock investing can be riskier than debt investing. With a debt investment, there is an agreement that you will be repaid. With stock investing, there's no agreement like that. You basically collect your profits based on how the company does and what profit it generates. So if a company does really badly, and its profits fall to zero, you also get zero. So that's why stocks tend to be much more volatile, and the value of a stock can go down to zero, which is much less likely in a debt investment where you have a contractual right to be repaid. So if it's riskier, why on earth would anyone invest in stocks? So what we covered in the last class was that stocks as an asset class, even though they're riskier, on average and over long periods of time, they tend to perform better than debt investments. And so they're a very good way for wealth creation for someone with a long investment horizon. So that basically means you can hold the investment for a long time because the value of a stock can move up and down. And as long as you do your homework and pick good stocks, it proves to be a very lucrative asset class. And this class is all about how you figure out what a good stock is and what a bad stock is. So the last point we covered last time is this is not easy. And buying individual stocks is not for everybody. And even the best investors are right only 55 to 60% of the time. But the amazing thing is even that is enough to create enormous amounts of wealth because of the power of compounding and the power of doing this over and over again for a long period of time. So the key here is we're going to learn how to do this. And the key is it's not easy, but even if you decide that individual stock investing is not for me, having this understanding of what a stock is will help you, even if you're investing in a mutual fund, because you'll understand how these securities behave and you'll understand how to react, for example, in times like this. So with that, we'll move on to the content of this presentation. So this is a snapshot of what we're going to cover today. So we'll begin by understanding valuation. So valuation is all about figuring out how cheap or expensive a stock is, basically figuring out the price of a stock. So the key tool in figuring this out is something called the price to earnings ratio, which is sometimes abbreviated PE ratio. So you'll hear me use these terms interchangeably. Don't get lost, they mean the same thing. So P in the PE stands for price and E stands for earnings. The second topic we'll cover is understanding earnings better. So basically, what does the E of the PE ratio really mean? What are earnings? Where do they come from? What happens to earnings that companies generate? The next topic that we'll cover in this session is laying the foundation for next class. And next class is where we're really going to do some serious work in terms of understanding how professionals look at stocks and make investment decisions. So what is that we're going to cover? We're going to cover what financial analysis is, what the tools are that you use to do financial analysis, and where you can get the information to do the financial analysis. And in the next class, we'll actually start doing some financial analysis. Okay, so let's jump into the topics today. So let's dive into what the price of a stock really means. So one of the biggest misconceptions that a lot of beginners have when they go into stock investing is that the price of a stock is simply what's quoted. So we all have seen CNBC and we've seen that little ticker tape at the bottom, which has all these securities and the price that is being quoted in the market. So while it's tempting to think that is the price of a stock, that's really only one factor in the equation. There's a second half that we have to look at, and that's what we get in return for buying a stock. So when we buy a stock, right, we're buying a piece of a company, which gives us a claim to some future earnings. But we don't know how big that claim is based on the price. So to compare the price of stocks, we also need to know, okay, I paid this much for a stock, but what am I getting back? Am I getting a big piece of the earnings pie, or am I getting a small piece of the earnings pie? So that's really the second factor in figuring out what the price is. So if we go to the next slide, the PE ratio is the key way where we can compare the price of stocks across stocks. So the PE ratio allows us to compare. So the P stands for the quoted price. So this is what you see on CNBC. And the E stands for something called earnings per share. That basically means if I buy one share for the price that I pay on CNBC, how much in earnings do I get for that single share? So let's walk through an example at the bottom. So we have three stocks: stock A, stock B, and stock C. In this example, stock A has a CNBC quoted price of 200 rupees. Stock B has a quoted price of 500 rupees, and stock C has a quoted price of 750 rupees. Stock A has an earnings per share of 10 rupees, stock B 50 rupees, and stock C 50 rupees. For now, don't worry about where this earnings per share number comes from. We'll cover that, don't worry. That'll be in the next class, you'll see very clearly where this comes from. For now, just understand that this is another number that we use to calculate the PE ratio. So when computing the PE ratio, I simply take the price per share. So for stock A, that's 200, divide by 10, that gives me a PE ratio of 20. For stock B, I do the same thing and I get the number 10. And for stock C, I get 15. So what does this tell me? So basically stock A, I'm paying more for the level of earnings I'm getting because that number is higher. So that means I'm getting less earnings for the price I'm paying. Stock B, I'm getting more earnings for the price I'm paying because it's cheaper, because the PE ratio is lower. So basically, the lower the PE ratio, the cheaper the stock, because I know that for every share I buy, I get equivalently more earnings in return. So that's really how we measure the expensiveness or cheapness of a stock. And so the lower the ratio, the cheaper the stock, and the higher the ratio, the more expensive the stock. So this begs a question of why some stocks are pricier than others, right? So why is it that some stocks trade at 100 times PE, like something like DMart is very expensive? Then you have something like a bank which trades at 20 times PE. What explains the difference between how stocks trade? So when people look at PE ratios, they're basically pricing in a few different characteristics for a stock. So the first is, because when you buy a stock, you're getting the claim to future earnings streams. If you expect the earnings of a company to grow, you're going to be more interested in owning that stock because you're going to earn more and more money over time, because that earnings that you have a claim on is going to become larger and larger and larger. So if you expect a company to grow earnings, you're going to be more interested in owning the stock. So that pushes the price up for that stock. So that results in a higher PE ratio for that stock. So a good example of this is DMart, right? So DMart or Avenue Supermarts is a stock which is expected to grow very quickly. And as a result, they trade at a very high PE ratio. Now let's look at the second factor. Second factor is risk and uncertainty. So a good example for this is Nestle India. So in 2015, June of 2015, Nestle India ran into some issues with accusations of having lead in their Maggi noodles. I'm sure a lot of you remember that. And essentially, they were banned from selling this product in the market. As a result, Nestle India's PE ratio fell by 20% because investors were not sure if the company would ever be able to sell those products again. And if they weren't able to sell those products, their earnings would be lower. So as a result, the PE ratio fell for the company. And eventually they were able to sell those products again, and the risk vanished. And now Nestle is trading at a higher PE ratio than it was even before the crisis. The third factor is a little more confusing. It's called liquidity. We covered this briefly in the last session, but liquidity, again, for those that didn't make that session, is the ability for you to sell something. So let's take the example of a house. It's pretty tough to sell a flat or a house because there are transaction costs. You got to find a buyer, and it's not just as easy as calling your broker and selling a share, right? So we say that stocks in general are more liquid. It's easier to sell than a house or property. Now let's take the example of stocks in more detail. There's some stocks which are very widely traded. There's a very big market of buyers and sellers. So think of a stock like Reliance. Everybody knows about Reliance. They all are familiar with the company. There are lots of shares in the market, lots of people selling and buying on every day. So I know that if I own some Reliance shares, even if we have a crisis like we're having now in terms of the market going down, I'll still be able to sell my shares. But if I hold a smaller company that not a lot of people are familiar with and that doesn't have a lot of buyers and sellers in the market, I'm taking a little bit of a risk that I won't be able to sell that share when I really need to at the price I really want to. So the more liquid a stock, the higher the price of that stock tends to be, because more people want to own that stock. And so the higher the PE ratio tends to be. This is the least powerful of the three factors we mention here. But the reason we're mentioning it here is because it's very tempting when doing your analysis to find a small cap stock. So small cap stock means small, a small company, and say, look, its PE ratio is so low. But one of the factors you have to account for when doing that analysis is there an active market in this stock or not? If there's not, then there's a reason that PE ratio is so low. So this is a slightly more advanced topic, but it's one that you should just make a note of not forgetting as you do your analysis on stocks. So we're going to move ahead. So shopping for a stock is like shopping for a flat. It's really not that different. So the PE ratio only tells you the price of a stock. It doesn't tell you whether you should buy or sell, right? So let's take the example of a flat. If I'm shopping for a flat, right, I don't automatically buy the flat with the cheapest price, right? I ask myself, okay, here are the flats, here are the pros and cons of each flat, and this is the flat I think delivers me the most value for the price. So similarly, when we're doing stock analysis, we do the same thing, right? So we may actually opt to own a stock with a high PE ratio because we think the stock is worth it. So what I've put at the bottom is the real holy grail that we look for. The holy grail is finding a company we think should have a higher PE ratio than it does. So if you find a company and you're saying, wow, this company has good earnings growth, it doesn't have a lot of risk, I'm not worried about anything with the company, and its PE ratio is lower than a lot of other companies in the market, you know what? I think I should buy this company. That's a good investment decision you just made, right? You may be wrong, but you at least have a point of view that's saying that, you know, this is why I think this is a good company. And a sign to sell is exactly the converse. A company we think has too high a PE ratio, we're saying, wow, I don't understand why this company is trading at such a high PE ratio. You know, the market doesn't seem to be appreciating all this risk. That's a sign that you should sell your stock. So we'll keep moving. So one tool that's very important in sort of doing your stock analysis is realizing that PE ratios are not absolute, they're relative. And PE ratios tend to change based on conditions that happen over time. So I'll give you an example of, let's go back to owning a flat. Now, if you're searching for a flat, right, and you're searching in different areas, you find one in Bandra, for example, one in Andheri, one in Khar, one in Kolaba, you know, one in Borivali, right? And you look at the prices of these flats, right? They're going to be impacted by the neighborhood, right? So some people are gonna right, the desire to live in Borivali is different than the desire to live in Bandra, and the types of people that want to live in Bandra are going to be different than Borivali, that are going to be different than Kolaba, that are going to be different from all these areas, right? So when you're shopping for a flat, what do? You look at the prices in your area and you compare that to the flat you're seeing, right? And you say, is this a good deal? We need to do the same thing for stocks also. So when you get the PE ratio of your stock, you have to compare it. So many industries have very different PE ratios. So let's take FMCG as an example. If you take a look at some of the stocks like Hindustan Unilever, Nestle India, Britannia, Dabur, these companies are trading at very high PE ratios relative to the banks, right? Or relative to manufacturers, or heavy equipment manufacturers, or PSUs, for example. Now, that's because different industries have different characteristics based on the factors we talked about before, right? The growth rate of an FMCG is very different than the growth rate of a bank. The risk of a FMCG is very different than the risk of a bank. So doing relative analysis is an important check on your analysis. So I recommend for every stock that you analyze, you also look at its competitors and peers. So you understand how is it priced relative to companies that look very similar to it, not just the market. Also, the overall market also fluctuates in PE ratio. So the long-term average for the market of all stocks is around 20 times when we look at it over long periods of time. The current PE ratio in the market is also averages to around 20 times. But this number moves up and down based on how confident or nervous investors feel. So for example, before COVID hit, the market was trading at 27, 28 times PE, right? And then COVID hit and PE ratios fell, right? So the optimism and pessimism of investors also impact the PE ratios in the market. So you also in the back of your mind want to keep in mind when you're looking at a PE ratio, the relative strength or weakness of your PE ratio. Just like you can have good real estate markets or bad real estate markets. Okay, so now now that we've like understood valuation and the PE ratio, we'll turn to the E of the PE, so earnings. So let's understand what earnings actually are. So you'll recognize this diagram. We reviewed it in session 1. So this basically walks through how a company functions, right? So a company is a machine. It takes inputs from investors, and it produces products and services which it sells to generate revenue. In generating these products, it also has costs, right? So let's take a few costs that could come up. So they may need people, so they'll have salaries. They may have an office, so they'll have rent. They may have material costs because they need them to produce their products. They may have interest to pay to people that they've borrowed money from. So earnings is basically the difference between the price I sell my goods at in a period and all my costs in that period. So it's the net profit that I generate in my company. And that net profit belongs to all the equity investors that own the company. So if you own a share of that company, you will also get a share of those earnings. You have a right to a share of those earnings. And how big of a share depends on how many shares you own. So if you own 50% of the shares, you'll also have a claim on 50% of the profits of the company. So that's really what we mean when we say earnings. Okay, so what happens to earnings earned? So the answer is it depends on what the CEO and other managers and board decide to do with them. So sometimes companies decide to return these earnings to shareholders. And there are two ways they do this. One is through buying back the stock, which is a little bit more of an advanced topic, which just park for now. It's not very critical in understanding. And the other is dividends. So dividends are basically when the earnings are paid back to the investor. So, and this doesn't need to be an all or nothing decision. You can decide to pay back, a company can decide to pay back 50% of its earnings. It can decide to pay back 20% of its earnings. It's up to the company, right? But that's what it means when you get a dividend from a stock. It's the company giving you a share of the earnings they generated that belong to you. The other decision that a company can make is, no, I don't want to give this money back to shareholders right now. Even though this money belongs to them, I'm going to keep it in the company and use it to grow my company. So let's pretend that I owned a company that had a shop, right? And you were a shareholder in my company. So I generated some profit and I said, what should I do with this profit? On the one hand, I can dividend it back to you, or I can use it to open another shop, right? So I can take my one shop and turn it into two shops. And so companies often decide to reinvest their earnings rather than dividend them back because they can earn a good return, good profit on reinvesting it. So that allows the earnings to grow even faster in the future. So the investor still has a claim on the earnings. They're just reinvesting it for the future. So a lot of growth companies that are growing quickly tend to do this. And a lot of mature companies tend to actually pay the dividends back to shareholders. That's why you'll see some companies that pay dividends and some that don't. Okay, so now we've covered what happens to earnings. So now I want to get to laying the foundations for next class. So we're going to start the process of actually looking at a stock. So it'll be a lot of fun, and I hope you guys join us for that. And you'll see that it can be surprisingly interesting and fun and easy once you know what you're doing, right? And we'll teach you how to look at the stuff and understand what's going on. So the key here is, look, you wouldn't buy a flat without going and visiting it and checking it out and doing a walkthrough and inspecting it, right? Same thing with a stock. But how do you inspect it? You can't go to the company, walk around headquarters and talk to everyone that you want to talk to, right? That's not feasible for most people to do. Well, the good news is that companies provide a lot of this information at your fingertips online. So almost everything you need, actually not almost, everything you need is available online. And your toolkit is going to be basically the reports the company publishes and your mind and judgment. So the most famous example of this is Warren Buffett, who I referenced in the first series, who's the most famous stock investor of all time. Even he uses the exact same tools that we're going to use. He has a very famous quote that other guys read Playboy, I read annual reports. Warren Buffett is famous for not even taking meetings with management and basing all of his investment decisions on the private readings that he does on the annual reports and etc. So that should feel very inspiring, that you have the same tools that even the most famous investor of all has. And you can also, if you make the right calls and right decisions, be equally successful. Now, that's not easy, but it's inspiring nonetheless. So if we go to the next page, so what are we trying to do with this information that we're gleaning, right? So there are really three factors that we're trying to do in financial analysis. And I've also given you a little preview of where we get this information from. So all of this information, first of all, comes from the annual and quarterly reports of the company. So the first is we're trying to say, what is the earnings power of the company? How much do I think this company will generate in earnings in the future? Now, my best guide for the future is the past. So my starting point is something called the profit and loss statement. This is sometimes also known as the income statement of the company. So remember that page where we reviewed what earnings are, right? So the profit and loss statement does exactly that. It starts from the sales, the revenue of the company. So what price it sold its products for in the market, and it lists out all the costs, all the major costs that come into producing that revenue, and it works down to the earnings of the company. So it gives us a way to account for the difference between what the company sold its products for and what it actually generated it in earnings. So this is where we get our earnings number from, and I'll show you exactly where to pull it next week. The other thing we look for in this is management commentary, right? So understanding what management is saying about their profit and loss, and what's impacting the profit and loss in certain periods. So typically when we're doing analysis, we look at the profit and loss over sometimes 5 years or sometimes 3 years to get a sense of how the company is doing over time. Okay, now when we look at what are the risks of investing, one of our biggest tools here is something called a balance sheet. So a balance sheet is basically telling us at any given point in time, right? What does the company owe to other people and what does it own? So we will use this to see how much debt a company has taken. Just like with a individual, if a company has taken lots of loans, right, it becomes riskier. So if I've taken lots of credit card debt, taken a huge mortgage, taken an auto loan, I'm living on thin ice, right? Because I don't have a lot of income outside of all that expense, right? So similarly, we look for that with a company, and we use the balance sheet to do analysis on how risky or safe a company's uh, 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 sort of capital position is. So both the profit and loss and balance sheet are talking about the past of a company. But we are interested in what the future is going to look like. Because when we're investing in stock, it doesn't matter what the company generated in the past. What we care about is, what is this company going to do for me in the next 5 years if I want to hold the stock for 5 years? So our best tool that's in the annual report for figuring out what the future looks like is what management tells us their plans are for the company. So management typically gives a lot of commentary around how it sees the market, what its plans are, what are the challenges in the business that it expects to face, what are the opportunities, what they're doing strategically to take advantage of the opportunities. So that helps us also think, do we like what management's doing and how do we see the future shaping out? So this is a snapshot of all the information we can kind of get from the financial reports. But there's other stuff we can do too. So beyond the reports, some of the other factors you look at when making a decision to invest or not is assessing the quality of the management team. So management team means the senior employees of a company. So the CEO, CFO, COO, head of sales, etc. So the good news is, this day and age, all this information, a lot of it for big companies is available at your fingertips. You can look on YouTube for interviews. So for example, the CEO of Hindustan Unilevers was on CNBC recently. So you could see that interview. Do you like what he's saying? Do you like how he's thinking about the market, you like what he's saying about his company. So how good or bad do you think the manager is? That's going to make a big difference to how the stock performs. The next is you need to figure out how much competition does this company have. So as we all know that there are multiple companies targeting the same customer, right? And the most successful companies have an ability to serve that company better than their competitors. So you're trying to figure out, does your company also have an edge over its competitors? And the more of an edge it has, the more it looks like something called a monopoly. So a monopoly is the ideal company where it has no competition and it's the only game in town. So a lot of you may be aware that Microsoft, for example, in the late 90s was prosecuted for being a monopoly, right? Because people felt that no company could compete with Microsoft. And you could see how insanely profitable Microsoft was. So what you're searching for is companies that have some aspect of moat around their business and some edge versus their competition. The last piece that we kind of think through is, how is the overall market? So let's take the example of, let's say that, I had a thesis that I think Maruti may be a good investment, and my thesis on this was, look, I see tons of Uber drivers, and these Uber drivers need to upgrade their cars. New Uber drivers will come and buy new cars, and a lot of them are driving Maruti vehicles, and it's created a lot of demand for vehicles, right? So maybe I think Maruti will do well. Now that's a good analysis in some fashion, but without thinking about the overall market, you could be missing some big holes. So for example, COVID has just hit. How are the Uber drivers doing in general? Is the overall car market going to be impacted severely? Are people going to be able to raise debt for cars, right? So even if Maruti is a terrific company, even if they're going to gain market share in the Uber segment, even if all of that's true, if the market is so bad that I don't think they're going to be selling cars, right? Then maybe it's not a good investment at the PE ratio that it's trading at now. This is just a hypothetical. I've not even looked at Maruti. I'm just giving it as an example of the style of investing you would do, or the style of research you'd do on this. So that's really what I wanted to cover. One last thing is I want to tell you guys how to get this information. So any publicly listed company will have something called a investor relations section of its website. So here I'm showing you the one for Hindustan Unilever, right? So if you hover over investor relations, it pops up all this information. And I've circled in red the key things that we're interested in. So one is the quarterly and annual reports, and the second is company presentations. Not all companies will have company presentations, but all of them will have quarterly and annual reports. So this is the kind of information that you want to download, you want to read through, and you want to just basically digest as you're thinking through investment opportunities. And we'll actually do this together over the course of the next few videos and see how we kind of take this to the next level to actually make decisions. So with that, just piecing together what we're going to do next time. And this may split into multiple classes. I still haven't developed the content, so I don't know how many classes it'll take to get there, but we're going to start analyzing a stock together. We'll go through the key parts of the annual report. We'll learn how to read a profit and loss statement, and we'll learn how to read a balance sheet. So I hope this class has been helpful. And with that, we can move to Q&A.
Okay, so we have a bunch of questions. I hope we can answer them all. The first is, we hear buy growth or buy value. What does that mean in terms of PE?
Good question. So, people will have different definitions for this. In general, the kind of heuristic I'd use is take the market PE. So in this case, 20 times. I would define anything trading at below 20 times value. So below the average PE in the market. Anything trading above 20 times, I define as growth.
Okay. Can I just use the PE ratio to make decisions, or should I use other factors such as other ratios to make decisions? And how much can I trust the PE ratio as a metric of comparing stocks?
Very good question. I'm glad this question was asked. So, to be very clear, a PE ratio should never be used in and of itself to make an investment decision. A PE ratio should always be used as a point of reference. So think of it as a price of any good. Would I ever decide on buying a car based on the price of that car? If that were the case, I'd either buy the cheapest car I could find or I'd buy the most expensive car I'd find, right? But that's not how people that are rational sort of make decisions on buying a car. But a lot of times we fall in the trap of making the same silly decisions on stocks, right? We'll just say that, oh, this stock has got a low PE, I'm going to buy it. No, that doesn't make sense. It could be a good stock, but you have to do the work of saying, do I think this company do, do I think this company has more value than its ratio gives it credit for? So the PE ratio is an input in your decision making. It should not be trusted to make the decisions, and that holds for all ratios. And there are lots more ratios, and some of which we'll cover in later classes, etc. But ratios are just math. If investing in stocks was as easy as ratios, computers and calculators would leave no market for us to make money in, right? But a lot of this comes down to judgment, research, and homework, which is why even someone that's new at this can do really, really well at investing, because even someone that's new has very good judgment, right? Even someone that's new can forecast the future maybe better than someone who's knows what all these ratios mean, right?
Okay, so can you comment on past slash trailing earnings versus future slash projected earnings?
Very good question. So this gets into a little bit of an advanced topic that I didn't touch on in the presentation, but for beginners, the listener is asking the question that what is the difference between using a forward ratio and a trailing ratio? So what I've been talking about in this presentation is trailing ratios. It means looking at the past, figuring out what the earnings were in the most recent period, and using that as your E for the PE ratio. What the listener is asking is, some people actually say, okay, I've seen the past, but I think a more relevant PE ratio is to look 1 year in front or 2 years in front and guess what the earnings are going to be. And I'm going to use that number as my E for the PE ratio. So this obviously requires you to make a judgment about the future. And this comes down to style. I personally I'm not much of a believer in forward PEs, because I think using a forward PE basically almost means you're giving 100% credit for the company hitting its next year's earnings or next 2 years earnings. And that kind of basically takes you one step away from analysis, right? You're just basically saying, okay, they're going to hit their next year's earnings, so I'll just pretend that that's been done already. So my personal bias is to always look at trailing earnings, because that's actually in the bag. That's actually what has been realized. But either way you look at it, the key is to be consistent. So if you're going to look at forward earnings for all your analysis on competitors and all of these things, use the same convention. And the only thing I'd say is the danger of going too far out in the future is the future is uncertain, right? So anytime you're making decisions based on 1-2 years out and using them in your ratios, realize that that's still a number that can be missed, right?
Does it make sense to identify a cheap stock and then refer to the PE ratio, or do the opposite? Look at the PE ratio and then look at how cheap the stock is. I guess he means how good the stock is.
Yeah, so good question again. This is again a stylistic question. I've seen people do it both ways. When I was doing this professionally, I would basically start with my analysis of the company. Then I'd come back to what I thought was a fair PE ratio for this company. And then I'd compare it to what the market was actually saying. And the reason I did this way is I wanted to prevent any bias from creeping in. If you do it the other way, you run the risk that you've seen the PE ratio and it's going to bias how you analyze the company. If you do it the other way around, like I'm suggesting, you will actually be able to eliminate the risk of bias.
What is DDT? And from April 1st, 2020, DDT was abolished. What's the impact of something like that?
So I think DDT refers to the dividend tax, is what
Yeah,
I'm guessing.
that's, yeah.
Yeah. So the dividend tax. So prior to April 1st, dividends were taxable at the corporate level, which means that they were taxed when a company paid the dividend. So again, dividends for beginners are when a portion of the earnings are paid back to investors. So each investor earns a dividend. So in the past, dividends were um, sort of taxed at the company and not at the individual level. So I wouldn't pay tax on the dividend, but the company that gave me the dividend would pay tax. That has now been abolished. And what's going to happen now is that instead of the company paying the tax, the individual is going to pay the tax. So because the tax rate is higher for an individual than it is for a company, because the companies were being charged only 15% on this, but an individual tax rate will be significantly higher than that, depending on your tax situation. This will result in dividends being a less efficient way to return money to shareholders because of the increased tax leakage. So you would expect dividends to become less favored in the markets now.
Okay. RBI has stopped banks from giving dividends till further notice. What are the implications?
Yeah. So I think it's helpful to understand why that decision was made. So why that decision was made is that we're currently going through a period of stress in the financial markets. So banks have given out loans to a lot of customers, a lot of companies, and they were counting on those loans being repaid. But because of COVID, a lot of businesses have been impacted. Uh, let's say that I took a loan from a bank for a restaurant of mine, and suddenly there are no customers coming into my restaurant. I can't pay that loan back, right? Or at least in the near term. So banks' cash flows are going to be impacted because they were counting on this money coming back, and that money is not going to be coming back. So as a result, RBI posted this dividend restriction to help companies, banks preserve their cash flow and manage through this time. So it's a temporary thing in the sense that once the banks are through this crisis, the dividends will be reestablished. But in the near term, anyone that's owning banking stocks that was getting a dividend check from them or dividend proceeds from them will no longer be seeing that income until that ban is lifted, right? And this is actually in the long-term interest of the bank because it cannot afford to pay those dividends right now, given what's going on in the market.
Okay, price to book value of the company, how relevant is this?
Great question. So price to book value is another metric that a lot of people use. It's a very relevant metric for financial lenders. But it's not a very relevant metric for most other companies. And this is a bit of an advanced topic. So, but the real reason, and I'll get into this because I think it's a good question, but beginners may not follow this, and it's okay. Don't worry about it. This is a bit of an arcane question. The person that asked it is clearly a pretty advanced investor. The reason is that banks, the way the model works is they raise lots of capital and they keep raising capital, right? So how does a bank function? It raises deposits and it lends out those deposits, right? It raises equity and it uses the money that it gets to lend out that money, right? And so its book equity is a very meaningful number because that book equity is reflective of how much money it's raised in terms of shareholder proceeds. And so the profit it generates on that is very relevant. So price to book equity is telling you, if I were to liquidate the bank, if I were to say I'm going to stop the bank now, right? So my assets minus my liabilities is what's left as cash that's sitting with the bank, right? And it's telling you that this is the value of the bank if I liquidated it. So price to book is telling you the extra premium you're paying for the money sitting in the bank. So that's very relevant for a bank. But a company like Hindustan Unilever, as an example, they don't raise a lot of money, right? Hindustan Unilever raised some money way back in the day, and they have never needed to raise any money again because they just keep reinvesting the profit they're generating in their company again and again. So the book value doesn't make a lot of difference to how you look at the share.
Okay, so when you say balance sheet, are you including a more detailed analysis of the cash flow statement and the assets and liabilities breakdown?
Yes. So in terms of the asset and liability breakdown, yes, we'll be covering that. Maybe not in as much detail as an advanced investor would look for, but we'll do another series catered to advanced investors in this, where we'll actually do very detailed balance sheet analysis. In terms of cash flow statement, I think that's beyond the scope of this course. Again, in an advanced course, we can do analysis on cash flows as well. So for beginners, a cash flow statement basically is a third statement beyond the P&L and the balance sheet, which ties the two together and shows you how the net cash position of a company changed. And it's a good analysis and required analysis, but it's for very detailed financial analysis, which in my opinion is even beyond where you need to be to do investment decisions. I made a lot of decisions in my past investing without doing much detailed analysis on a cash flow. So there are a few key line items that we need from a cash flow, which I'll walk you through when we do an analysis. So.
Okay, there's a question, well, it's a comment. Soft issues like quality of management, governance, industry dynamics, growth, overall market PE, etc., impacts the PE.
Yes. Was there a?
It's just a comment, actually.
Yes, that's a good point. That's absolutely true. But what I would say is they impact the PE absolutely, but they impact the PE through impacting our judgments about either earnings or risk, right? Because if a company has a better management team, you may feel the company is less risky. So you're absolutely right. These are critical inputs into PE, but ultimately they filter through either your view on the earnings generation potential or the riskiness of the asset.
Okay, there's one question on the term PEG ratio. What is that?
So PEG ratio, it takes the PE number that we calculated earlier and it divides it by the earnings growth expected value. So this tries to look at the factor that I told you about earlier, that companies that tend to grow earnings faster have a higher PE ratio. So this is trying to account for that. It's trying to say, okay, if I take two companies and I know their projected earnings growth for the next 5 years, how can I see which one is cheaper than the other, right? So what it does is it takes the PE ratio and divides by the growth rate. So let's say I had two stocks, right? One that was trading at 20 times and I expected its earnings to grow at 20% CAGR. Okay. And I had another stock that was trading at a 10 times PE ratio, but I expected that company to be growing at, let's say, 5% earnings growth rate, right, per year. So if I divide those two numbers and multiply by 100, right, which is the PEG formula, I would get 1 times for company A, 20 over 20% times 100, right? And I would get 10 times over 5% times 100, which would be 2. So this would tell me that relative to its expected growth rate, because company the second company is trading at a higher PEG ratio, it's more expensive than the first company. Again, this is a more advanced topic, and PEG ratio is not a very utilized tool, uh, but can be useful to benchmark across high growth companies.
Okay, so I think that's it for the questions. If anyone's question was inadvertently left out, please send it to advisory@bharosaclub.com. Maybe Sahil, we can have a session after these sessions are over for the more advanced people, because there seem to be quite a few of them.
Sure, absolutely. And, just before we wrap up, I've put some commentary on what the membership gets you. So advanced members in particular should, I think, really look at joining the club. We'll get access to more learning content, as well as we're planning to do some research and post research notes also periodically to our WhatsApp group. So it's a steal. It's 1,000 rupees for a full year. And, you get added to our WhatsApp group. So you'll be well apprised of all of our seminars and be able to ask email Q&A and have access to our research notes when we post them. So, and we will do some seminars for advanced listeners for sure, once we're through with this beginner series. And that'll be also pretty good stuff. So look forward to hopefully seeing a lot of you come back for next week. And please let anyone you want know. There's no restriction on members, non-members joining this session. And if you miss a video, they're always going to be available on our YouTube channel. So please subscribe on that, and that way you'll be able to stay in the loop. And yeah, thanks everyone. Have a great rest of your day, and please stay safe. Thank you.